I remember one of the things you do when you're supporting a new client in the insurance industry is first you look to see what they currently have. Because there's an aspect of insurance where if you have a policy that is really good,
if it makes sense, if it ain't broke,
and you're locked in,
right,
and you, let's say you got a pre-existing condition at that time, a pre-existing condition would
make it more difficult for you to get something new.
Yes, and in fact, what they do is they put what's called a rider on it. So let's say, for instance, you had a knee injury and you had to get surgery like you've had, right? And then you went to get a new policy, they'd say, we'll cover you, but we're not covering your right knee because you had an injury to that right knee and we're not taking on that liability, right? So in going through there's a process, it's called underwriting. Just like the mortgage industry where you go through and you see someone's credit worthiness, their income, their stuff like that. This is where the underwriters of medical insurance companies go through and look at the insurability of the potential client, meaning they look at all your health records to see what has happened in the past that might potentially lead to a huge claim coming later that the insurance company, what they're trying to do is limit their exposure. So going back to my story, this gentleman, he had a policy and it was, I forget the name of the company, but I remember it was called the Schedule of Benefits Plan. And a Schedule of Benefits Plan is a plan where they say, it's similar to dental insurance, where we'll pay up to $2,000 for this specific thing.
Okay.
We'll pay up to $5,000 on this specific thing. And they just have literally a schedule of what they're willing to pay for specific occurrences. These plans are the worst kind of plans you could get. It's all a contract. This is all paperwork that says we're willing to do X if Y happens, right? Wow.